Hello everyone, welcome to the final podcast of Fieldfisher's Africa Week 2020. Some of you will have had the opportunity to listen to Jonathan Thomas before. He very kindly spoke at Africa Week last year, and he held, if I say so, a really brilliant session looking at women, democracy and economic growth. Those of us that were lucky enough to be there sat on the end of our seats, and he had us all in the palm of his hands listening to some really fascinating observations about economic growth across the continent. We thought that it would be remiss of us this year to end Africa Week without looking a little bit at what Covid-19 was doing to some of the economies across the continent, and also having a look at what might come in the future. So Jonathan's presentation is especially interesting because he gives us an insight into some of those issues which we've been grappling with. So how will Africa be able to become more productive economically? How can some of the economies do more within the continent itself, and how can some of the economies begin to do more by way of exporting across the rest of the world? I am absolutely certain that you will enjoy the presentation that Jonathan's about to give. Jonathan will be happy if any of you want to contact him and raise any questions on his presentation. But let me hand over to Jonathan Thomas to talk about COVID-19 and checking Africa's pulse.
Thank you very much, Cicely. I'm going to start off with the state of play as far as kind of COVID-19 at the moment is. So far, I think most, if not all, kind of commentators are quite agreed that it's been a comparatively kind of benign pandemic so far in several ways. Africa's share of kind of cases and global fatalities at the moment are relatively kind of low. And the death rate or the fatality rate per case is also kind of low compared to Europe, North America, the global average, and South America. Asia had already peaked in terms of the pandemic a long time ago, but there's not too much of a difference there. Now, it's true that kind of background factors and some of the underlying kind of features of African economies and societies have helped. What we've done here is we've basically picked up some points of the distribution at the global level of the death rates, the deaths per million population, the median age of the global age at the global sort of level, the percentage urbanized and population kind of density. And as you can see, there's a clear positive relationship between the death rate with older populations, more urbanized populations, and the populations where the density is sort of higher. And what's important here is that Africa lies in the lowest kind of percentile of all four of those kind of categories. So in a sense, these three background features of Africa as a whole have helped to keep the death rate sort of low. But it's too early for us to break out the champagne yet. As you can see, we've tracked the cases from March the 29th up to the weekend. And as you can see, it's accelerating and it is nowhere near the peak. So it's still early days. But what we have done is we've looked at the growth rate of sort of cases and the kind of fatalities, and we can use those to make some projections. At the moment, we've got about 240,000 sort of cases and about 6,500 fatalities. In about a month's time, at current rates of growth, that will rise to about 650,000 and 16k fatalities, and by 60 days' time, in approximately 2 months, we'll be pretty close to 2 million and pretty close to 49,000 fatalities. And just as an aide-memoire, it's worthwhile comparing this to the 2013-16 West African Ebola outbreak, where we had kind of 29,000 cases in total and 11k sort of fatalities. So at the moment, we're behind the curve as far as Ebola was concerned, but it won't be long at current rates of growth before we surpass what we saw then. And what that immediately kind of tells us in that simply in terms of the direct economic impact from a loss of kind of human sort of capital and the diversion of resources towards tackling the pandemic, there could be a steeper effect, and it's going to be kind of continent-wide as well. But I'll come on to that as we proceed. It's worthwhile thinking about, has there been a surprise in what we've seen in Africa, either good or bad? And as you can see, what we've got here is we've looked at the movements of African sort of currencies, both over the past month and over the past year. And I'll draw your attention to this box here. Any of the countries that are in this box here have seen a depreciation against the USD over the last month and over the last kind of year. So if you like, these are the low performers here. There are two key points I think that come from this chart. First, most of the observations are pretty close to a very kind of little change against the dollar in the past year and the month. And those that are in this box, it's really only Angola, Zambia, Seychelles, DRC, Ethiopia, and kind of Mozambique that stand out. And in each of these cases, it's possible to tell a story that is not a kind of COVID-19 related. And we can get a better picture of that if we compare what's been going on in Africa with what's been going on in kind of Latin America, which is pretty close to what we're seeing in Africa in terms of where the state of play of the pandemic is at the moment. As a whole, there is nothing that we see there that would make us think that Africa is way out of kilter with what we've seen against a comparator, and indeed what we've seen in the rest of the world. So there doesn't seem to be at the moment an outsized African sort of problem as far as the evolution. That's what these currency movements are telling us. But there are going to be some impacts, and we'll go through the key sort of channels. The first is obviously the lockdown. Now, I'll draw your attention to the red lines on both of these charts here. The first one is for kind of Nigeria, the second one is for South Africa. Now, what these red lines are showing us is how stringent the lockdown has been in each of the kind of countries. And these are fairly kind of typical of what's been going on in Africa so far. So around the beginning of March in South Africa, around the end of February in the case of kind of Nigeria, we've seen successive kind of pickups in what the government has decided has to close in terms of businesses, kind of transport links and shops, etc. Much as what we've seen in sort of Europe. But the key point is that at least up until the end of last week, these lockdowns still seem to be kind of holding. And this data comes from Oxford University, which has a centre which has tracked the intensity of lockdowns for every country where they've sort of taken place. So the lockdowns have remained largely intact. But what we know, and we've seen that from some of the European kind of nations, as well as some countries in Asia, that the more stringent the lockdown, that bears on growth. We've seen that from the Q1 kind of data. The lockdowns have got worse, certainly in Europe and across Africa, Latin America and kind of North America. They've got worse in Q2. So the pressing down of the lockdowns on some of the levers of growth, specifically consumption and investment, are going to intensify in Q2, probably a kind of Q3 as we go sort of forward. So there's bound to be a fallout of low growth in Africa, much as what we've seen in Europe here. You can see that in the UK, the GDP growth fell by kind of 2% in Q1, and that was a steep fall given that the lockdown, it didn't really take place in the UK until the third week of March. And you can see that in some of those other countries where the pandemic sort of broke out earlier, that the fall in GDP growth in Q1, or the fall in GDP itself rather, was much kind of stronger. But there are going to be some specific African influences which may kind of make things worse, but may also sow the seeds for a steeper kind of bounce back. Let's take a look at them. The first is that kind of commodity prices are likely to soften throughout 2021 from here on. Now, some of that is going to reflect the overhang of commodity price kind of softness in 2019. But a lot of that is going to be just a reduction in demand for some of Africa's key exports over the next year or so. Of course, oil is going to be at the bottom. We've already seen most of that impact kind of play out. But we've also got the key kind of metals in decline. And really, there are just a few agriculturals and a kind of uranium where we're going to see some small increases. So most of the oil exporters, all of the oil exporters, and most of the metals kind of producers are going to take a big hit. That's going to bear down on current account sort of deficits in 2020 and probably 2021. And it could also lead to some unsustainable sort of current account sort of deficits. And we'll come on to what that unsustainability means in a little while. But what's important here, and what I'll draw your eye to, is that 2017, 18, and sort of 19, in both averages and median sort of terms, the deficits were pretty kind of stable at about between 4 and 6% of GDP. In 2020, we're going to see some steep sort of declines in both. Another way of looking at this is that if we compare what happened to African sort of current account sort of deficits during the great financial sort of crisis, 2008 to 2009, 58% of the 54 sort of countries saw a deterioration in their current accounts. The forecast from the IMF are suggesting that that's going to rise to 74% this time around. And also there are going to be 17 sort of nations with a deficit of less than minus 10% of GDP. And by the time you get to minus 10% of GDP, unless you've got some huge kind of FX kind of reserves, you're going to have to borrow to cover that sort of shortfall. And that takes us really sort of nicely onto government sort of finances, which again, as you can see, from 2017, 18 and 19, they're going to kind of deteriorate. Another way of thinking about that is that in 2008, 7% of African sort of nations had a deficit that was worse than a kind of 5%. And that rose to 26% in 2009 as the financial crisis unfolded and when it peaked. This time around, we're starting from a poorer kind of position in terms of the number of kind of countries or the share of countries with a deficit in excess of a kind of minus 5%. And that is predicted by the IMF to rise to about 50% by 2020. So we're thinking that there's going to be a balance of payments kind of crisis for several kind of nations that's going to be quite severe, and a government sort of finance sort of crisis as well. In the past, governments could have relied on FDI inflows to try to ameliorate some or both of those impacts. But we've already seen that from about 2014, African FDI inflows have been in sort of decline. And because, for the most part, African FDI inflows do tend to track commodity sort of prices in terms of the inflows coming in to support the development, extraction and exportation of those commodities, we're looking for a further decline of about 25% between 2018 and 2021. Now the evolution of FDI is going to vary across the sort of countries. I've just picked up some key sort of markets here where we looked at what happened in FDI between 2015 and 2018. And the countries in black actually saw an increase. So while the overall average was going down, for South Africa, there was a 208% increase. Morocco saw a 12% increase. But there are others and some quite kind of significant sort of markets where the declines have been huge. Kind of Zambia stands out as commodity prices have completely collapsed over the last 3 or 4 years or so. And also kind of Nigeria as oil prices have sort of softened. So there's very much a country by country story here. The other key inflow that governments have been able to rely on in the past has been kind of remittances, largely from their expatriates abroad. But what we see is that these are also going to decline over the next kind of couple of years as work kind of declines in the countries where these expatriates kind of live, and some of the countries are going to take some huge hits. Zimbabwe, in terms of the percentage of GDP, looks like it's going to take the largest hit of about a kind of 14%, or equivalent to 1.7 billion. But even some of the larger markets, kind of Nigeria, in terms of the share of GDP, kind of remittances only account for about 5%. but a 24 billion shortfall, if that were to transpire, is going to be absolutely huge and sort of devastating. So what can governments do? Well, at the moment, there's been a bit of a focus on what the central banks can do. Many African economies and economic sort of frameworks involve some form of inflation sort of targeting. And what we've seen that inflation targeting has allowed in some of the more developed markets like the US, the Euro area and the UK is that the bearing down of the expected declines of inflation this year and next year have given policies some room in order to cut interest rates. But what we're going to see in Africa, partly because of the depreciation of currencies that are coming through, and partly because of some of the frictions in the supply chains, is that we're going to see that there is not going to be much leg room for reductions in interest rates. Some markets, like Nigeria, South Africa in particular, have cut interest rates already, but there's not much scope for much more of that. And that's going to be quite important because it means that the ability of these economies or the central bank side of the economies to support activity is going to be quite severely compromised. So what's the outlook then when we put all of these channels together? Well, the first is that I think, as is well known, we're going to see some sharp turnarounds in growth between 2019 and 2021. What I've plotted here on the purple bars are just what the growth rates were in 2019 and IMF and World Bank projections of growth in 2020. And you can see that for the most part, the growth was positive in 2019, and for many of the countries, it's going to be negative in 2020. And I'll just draw your eyes to Zimbabwe and Equatorial Guinea here on the left, where it does look as if growth will not be as bad, or growth will be better in 2020 than it was in 2019. But I think it's important to realise, and these are the only countries where we think that's going to occur, but it's important to realise that these countries were already in recession in 2019, and they're going to be in recession in 2020. If we compare where we expect to be over the next 2 years, or this year and next year, with where we were in 2019, in 2019, 7 countries were actually officially in recession. In 2020, that's going to rise to 30. In terms of growth rates, and there will be a bounce back in 2021 on central forecasts. I'll come to that in a minute. So in 2021, we expect there only be one country that will still be in recession, and that's likely to be Zimbabwe on the left-hand side here. In growth rate terms, on average, the continent economic activity grew by 3% in 2019. We're expecting a 2% deterioration in 2020, and then a 4% bounce back in 2021. But it's important, I think, to realise that the output losses in 2020 are unlikely to be completely recovered in the majority of countries by what's going to happen in 2021 during the bounce back. Now, and a part of that reason is that only 37 out of the 54 markets are predicted to grow faster in 2021 than in 2019. So there'll be some quite significant laggards who won't be able to recover as quick, at least as far as central forecasts are concerned. And I just want to say a little bit about multilateral support. Already the IMF has pledged 12 billion across the continent for this year through to October, and there'll probably be more to come. But that is barely going to cover debt interest payments of the continent, which accounts for about 15% of government revenues. So we won't even be standing still, or these economies won't even be standing still after the IMF support has come through. So the crisis will be real. Now, not all of these countries are going to go into recession. As you can see, some of the red bars are above the zero line. So let's look at some of the more significant ones that won't go into recession this year as far as we're concerned and the IMF and World Bank are concerned. Egypt, Kenya, sort of Ghana, Ethiopia, and Ivory Coast look as if they're going to record sort of positive growth in 2020. But the key point is that growth is going to slow significantly compared to what we saw last year. In the case of Ethiopia, it's almost going to be a third of growth in 2020 compared to the 9%, or just over a third rather, compared to the 9% that we saw sort of last year. So even though there's not going to be an outright contraction in several of the most important sort of markets, it's really going to feel like it. So let's think about some of the key risks for some of these outturns or the central forecasts that we're anticipating. The key one is going to be how the evolution evolves over the next year or so. And there are four key letters of the alphabet that I think are going to be quite important for us to be aware of. The first is a V-shaped downturn and recovery, where we go down into a recession or a slowdown fairly sort of quickly, and we bounce back sort of fairly sort of quickly. And this outcome is going to be on the proviso that basically after lockdown emerges, stops in sort of Q2 or the start of Q3, the business gets back to normal fairly sort of quickly, and we don't get any more significant outbreaks, and social kind of distancing, which is really going to be a break on activity in Africa, becomes completely relaxed in the second half of the year. That's almost a blue sky scenario. Then if we move down to a U-shaped evolution, a W-shaped evolution, and an L-shaped evolution, things get progressively worse. Under a U-shaped outturn, basically the emergency lasts well into 2021. And that's going to have more permanent impacts on output growth, but also on economic potential across the continent and across the globe. So basically, we flatten the curve, which is a kind of common sort of parlance for using a kind of testing and using the lockdown to keep the level of outbreaks pretty low, but that increases the duration of the pandemic. It gets even worse if we get a cyclical outbreak. This is the case where we get some repeated outbreaks once the initial outbreak has been kind of contained. In that case, kind of growth is even kind of lower, and we're going to have some cycles of shutdowns with relaxation and reinstatement of them. And the really kind of bad outcome is basically where we don't get any sort of recovery in the pandemic at all, and it really does kind of bear down on growth and on household and business sort of confidence. And the only solution is if the governments are able to find a vaccine, and that really is unlikely to transpire within the next 18 sort of months or so. And let's have a look at what these shapes mean in practice. The grey line is the V-shaped outcome. This line here, which is sort of the darkest sort of purple, is the W-shaped outcome. The U-shaped outcome takes us a deeper fall in activity in Q2 and a sluggish increase, and the L-shaped ones is where we don't actually kind of recover we don't even start to recover before the end of 2021. Now, at the moment, it looks as if the evolution of the global economy, and there's no reason to believe at the moment why these African economies aren't going to evolve in the same way, are probably going to follow a U-shaped downturn and recovery. And in that case, we're looking at real kind of GDP growth across the globe falling by between 5 and 6%, with a 3 to 4% recovery in 2021. What are some other sort of risk factors that we need to kind of think about, and some of the upsides that can sort of transpire? The first is we've already seen a postponement of the Africa, the kind of continental free trade area, the actual implementation of it. And that looks as if it's going to be implemented at 2021 at the earliest. Now, in principle, several kind of commentators have seen that as a bad thing, because there is no doubt that increasing intra-African sort of trade could in principle be a key offsetting sort of driver against the downside news from the kind of pandemic. But we're taking the view that actually it's going to give many sort of countries much more time to prepare, and they'll be able to better kind of take advantage of some of the upside in 2021 than they would have been in this July when the implementation was supposed to take place. The second is thoughts around the supply chain kind of disruption. There are already some fears and kind of commentary across many kind of senior kind of ministers that the reshoring of a kind of manufacturing and some kind of service sectors by kind of China and some kind of Western markets in particular is going to be a downside. But as far as we're concerned, that's unlikely to take place because the kind of labour costs across the continent are going to remain competitive. But also what it also means is that it will be quite a slow kind of process to disinvest. We've seen that investments in terms of FDI have fallen, but net inflows are still kind of positive. So there's still inflows that are coming in. The manufacturing base is still kind of being built. And if the free trade area becomes implemented in kind of 2021, it will be even more kind of capable to take advantages of the economies of scale that are going to be available. The third is that there's likely to be more kind of financial sector resilience, even though financial sectors are likely to see more kind of tightening conditions. What we've seen from some of the central banks at the moment that have cut rates is that they're very kind of confident in the ability of the financial kind of sector to compete with kind of to contend with non-performing loans and also kind of low returns on some of the loans that they're making. What we saw during the kind of 2007 and kind of 2008 kind of financial crisis was that the balance sheets of many kind of financial institutions were much worse than they are now. And that's really good news because there were some fears that what we could have had across many of the major markets in the continent was a feedback loop between a fall in growth and a fall in the resilience of the financial kind of sector. That looks unlikely kind of this time around. The fourth is that there are some fears about long run setbacks to productivity and investment. Some past epidemics across the globe, and I'm talking about sort of SARS, Ebola, sort of MERS, do look as if they've had some long run effects on the affected sort of nations that are pressed down on growth and activity more sort of generally up to 5 years afterwards. But what we're seeing across the continent, certainly from some of the short run kind of data that we're seeing, there's no kind of signs of that yet, but it's still early days yet in terms of the evolution of the pandemic. So that is definitely worth kind of keeping an eye on. But there's no sign that we're seeing these across the continent, and we didn't really see them across Asia, which has come out at the other side. So that's a kind of good news. A fifth is some concerns about kind of stalling the sort of progress on female empowerment. It is true that the informal employment in Africa has the highest rate of female participation. So what that means is that the shutdown of the informal kind of sector has really had a detrimental effect on female employment, incomes, etc. But the great news is that as the lockdown unfolds, these are very kind of low entry cost, low kind of setup costs, quite easy to implement enterprises, and we're expecting a really steep kind of bounce back. And because we're not going to have the impaired kind of credit flows, or they're not expected, when the bounce back occurs, there'll be far more kind of finance available from the private sector in order to fund them. So we're really quite optimistic that that the pickup in growth is going to be much kind of stronger than many of the commentators and multilateral institutions out there. And with that, I'll end. Thank you very much.